Hey traders, Richard K here from Price Action and Income. I hope you're all doing well and keeping safe during these times. Wherever you are, I hope you enjoyed today's video. I often get asked quite a lot about Elliott wave theory. It is a means of analysis that I do use quite often, although I'll be also one of the first persons to admit that it is or can be very subjective in nature, especially when you try to figure out wave counting within trends, which can be extremely confusing. There's a saying that if you take two Elliotticians and put them in the same room and show them the same chart, that they'll more than often come up with different opinions about the analysis. So yes, it definitely can be quite a subjective means of analysis, but as you all know that I use market geometry, which acts as a guide in combination with price structure. And in my case, I do use Elliott wave theory, but I really only apply them, to be honest, over corrective patterns. So in my opinion, corrective patterns, as you all know, is what I try to trade when they end and then try to get into a position when a previous trend continues again. So Elliott wave for me actually are the champions here in that sort of realm, if I can say that, in corrective patterns, because they really are it's the only means of analysis, if I can put it that way, that actually clearly identifies the various patterns that are, I can't say available, but that tends to pop up on a chart, and depends on which time frame you trade in. Obviously, there are only so many corrective patterns. There can't be any new ones because trading has been around for such a long time. Patterns just pretty much trace out according to traders' perceptions, fear and greed, the struggle between bulls and bears. So if you study corrective patterns, in my opinion, and just focus on what they tend to look like, then I think you've definitely ahead of the rest. Like I said before, Elliott wave theory, in my opinion, is the only means of analysis that really identified uh, all the patterns that are available properly and how they tend to behave. So there are many more, as you can see on my chart here, than these four that I follow. I tend to follow what is called a single zigzag, or some traders might just call an ABC. Then we have what's called a double zigzag, which is just a combination of two ABCs. And I'll be showing you some examples in a few minutes. Then we also have an expanded flat, and then triangle corrections is one of my favorite patterns to trade. So these are the four main ones that I follow. There are more, but if you're interested in applying Elliott wave theory or trying to understand how patterns tend to, or corrections, tend to evolve, then I really do suggest that you look into Elliott wave theory. But as you all know that I use market geometry as a guide, so I kind of loosely applied Elliott wave theory. I'm just more concerned about what actual patterns tend to look like, and then use my market geometry as a guide, like I mentioned before. So guys, I've actually pulled up two samples here. We're firstly just going to look at the Canadian dollar, Japanese yen. We won't be talking about any strategy today. I just want to be showing you some of these patterns and how they tend to actually pop up on the chart. So the Canadian dollar, Japanese yen could be any chart. I just used a sample for today's video. And if we went to go back to this 2014 high, you'll actually see that prior to this, that there was some sort of an uptrend on the daily, and then price start trending lower. So assuming that you were following at even this case when there was a lower high coming in, that you were or you had a bearish bias, then pretty much all of these corrections or larger corrections that appeared on this way down, even this one that went a bit counter trend, a much larger one, took multi-months to complete, actually more than a year, then using just market geometry and then knowing how these patterns tend to evolve will quite often help you a lot to distinguish A, which pattern you might be dealing with, and B, when a pattern actually changes, which can happen quite a lot, which I'll show you in a later chart, then you'll at least still be on the right track and then switch to what could then be happening. So Elliott wave could be very useful in acting as a guide, but like I said, as you'll see now, the market geometry really makes things stand out way better. Okay, so let's say after this first drop here, as you'll all know, I've done a previous video on this, that markets tend to behave in waves of 3s and 5s or combinations thereof. So again, just loosely applied here, after this high, price came down into a low and we had 3 major moves to the upside. Now, this, in my opinion, would just be a simple ABC, and it is one of the most common corrections. You'll find them happen all over the show and whatever time frame you're trading in. And as Elliotticians would call it, they call it a single zigzag. It could just be an ABC. An ABC will just move in 3 waves, and obviously the subwaves would subdivide in there. But this is where it's important that if you'll just use a pitchfork, you know that I quite like using a shift pitchfork when applied to corrections, and knowing then how these substructures work quite loosely, then you have a very good idea that correction, in this case a bearish correction, would end in most cases at your upper median line or your upper red warning line, which is exactly what happened over there. Obviously, again, in hindsight, but it's pretty crazy to see how these corrections tend to end at the end of, I'm going to say median lines, upper median lines, or lower median lines. And this one here, we barely touched the upper median line, price came down again. Again, just a simple A, B, C higher. Then we had a more clearer ABC over here, just using the first higher high and then a higher low, just loosely applying it. Price stopped dead in its track. First time around, the upper median line came down. Even if you were wrong about this and you entered there using proper management, you should have still been in this trade. If price then went back up again, you could have entered the second time around, and this time it would have worked out for you. And then just you can continue doing this all over the show. You'll have a lot of single zigzags popping up. Like I say, it's quite a common correction to unfold. Then we have what I just want to focus on this larger correction that we had here, which in my opinion is why Elliott wave can be so subjective in nature. It's like, how on earth would you count 5 waves if they would say on your first leg high here? And it's something that you'll quite often find in volatile times, is that you'll have a first impulsive move going in the upside, making it almost impossible to count these waves that they would label in between. That's why I'm not really too worried about actually breaking my head about actually counting these waves correctly. But if you would then at least have a strategy that can show you or indicate to you that a correction has sort of started, which happened at this stage, and I actually have tools that I use to check out where correction might happen firstly, and then secondly, how to know that a correction might be taking place. So if there's one thing you can take away about today's, or a tip that you can take away about today's video, then at least know that if you have an impulsive wave to the upside, that it's reasonable to expect that you're obviously going to get a corrective wave downwards, but you should actually expect that this will only be a corrective wave with another wave that's going to follow back to the upside again. That's a very reasonable expectation to have. So rather than trying to get into a trade here or here, it'd be much easier to wait for a correction low. And like I said, this applies to any chart. In this case, a higher high, another higher low followed by another wave to the upside. And it would be sort of when price actually created a higher low, you wouldn't know this until around here when price was approaching this previous high, that you can then again start drawing your market geometry. Just connecting that higher high to this low here. And in this case, you'll see that this is why Elliott wave is very important. In this case, price did not manage to break through and stay above the center median line of the shift pitchfork. And this is a sign of weakness, A, and B, knowing at least how these waves tend to behave in a single zigzag or an ABC. Single zigzags are just labeled as A's, B's, and C's. then you would know that a secondary wave, in this case it was way clearer than the first one, happened in 5 waves. And your B waves will obviously be corrective or combinations of corrections. And then your C wave in this case was 1, 2, 3, 4, 5. And it was at this stage, if you would have traded, I didn't trade this at all, it was just an example once again, you would have probably had a great idea that price will probably not reach this area here because you're already at 5 waves moving into this high here. So using a bit of combination of price structure now, they tend to evolve with your market geometry. If you did not enter here, then at least you would have had a good idea that once this lower median line was broken, that this high was actually the end of a correction and price then resumed back to the downside. Okay, so we've just been having a look at mostly single zigzags. Like I said, they tend to happen all over the show. Here we have another one. If we just use our shift pitchfork once again, we have a first wave to the upside. Always, in this case, we had 1, 2, let me just get rid of 1, 2, 3, 4, 5. Loosely counted, guys. It's not an exact science, or some people might think that it is. Like I said, we don't need to be that exact. We can just use our market geometry. And then again, price moved lower, and it creates a higher low. In this case, you would have known that's a higher low in case till price start moving and nearly touching this, or moving towards this previous higher high. And this would be the time where you just draw your pitchfork again. Again, price ended right there at the upper median line, and this correction ended and start moving downwards again. Next up, double zigzag. I can go through all of these little corrections here. I'm just for today's explanation trying to show you some tips and tricks when applied to actual corrections. In this case here, we had a first move higher. Then obviously price came down, and now it'll be reasonable to expect as price approaches this high again that we'll at least get an ABC. And what happened? Price did not manage to stay above the upper median line for a long time. It came down. If you traded this ABC, it would have been a good move. The problem with corrections is you'll never know that a correction that might just be a simple zigzag or an ABC might turn into something a bit more complex, like what happened over here. Well, this is where Elliott wave comes in again. If you entered at this high over here, use proper management, price might have reached one target if you had multiple targets, but at least at some stage, using proper management, you should be in at break even, not take a loss on this trade. So strategy obviously is very important, as well, as you all should know. But this is a great example where we created another higher low, and then price continued moving upwards. And at this stage, we had another impulsive move to the upside. When I say things moves in combinations of 3s and 5s, so when applied to corrections, you normally would see 1, 2, 3, 4, 5. But in corrections, there is no such thing as 5. There are different ways that you can try to explain this. But after the C wave of this initial 3-wave zigzag to the upside, when price broke above that high again, the immediate correction that I tend to switch to, it gives me a great clue that we might be dealing with a more complex correction, would be that it turned out to be a double zigzag. Like I mentioned before, double zigzags are just two ABCs after each other, and they are actually connected with and labeled a little bit different, as in Elliott wave terms will suggest. You have an ABC, and that'll be a W wave, an X wave, and then you have another ABC. So they call these WXY waves. Very simply, just two ABCs connected by what they call a WX wave. Now, how I kind of teach my students, and also what I'm trying to show you here now, is that quite often when you are dealing with an ABC or secondary ABC like we do see over here, then it's a very good idea to draw your market geometry over the second ABC as well. And just using the same pitchfork, guys, I have not changed my settings, as you'll see through all of these examples, that using just a shift setting here is that price couldn't get through the secondary C wave, or the Y wave as it will call it in double zigzag, couldn't get through the upper median line of the shift pitchfork, and price collapsed lower. Right, so those are the, I would say, the two main ones. The main ones are just simple ABCs. Like I said, you'll never know that ABC could turn into a more complex pattern. But when it does, and price continues higher, I tend to just say, like, we must be dealing with a double zigzag if you were still obviously at the bias that the trend is down. Okay, so we're all actually just assuming the whole time that we were trading to the downside and finding corrections in a bearish market. Okay, so those were your single zigzags, and as you could have seen using market geometry and especially your pitchforks, we could have in most cases sort of figure out where the end of those corrections might have happened, which gives you a really good edge in the market. And here we had a double zigzag, and just a quick tip, double zigzags tend to happen in 7 waves. 1, 2, 3, 4, 5, 6, 7. And our eliticians would call it ABC, XABC. All right, so that's what we got there on the double zigzag side. Let me just get back to the other examples that I have that I tend to follow. We got what we called an expanded flat and triangles. I'll just quickly jump to a triangle here. We've got a very noticeable triangle actually happening in the Canadian dollar Japanese yen at the moment. Now, whether this is going to have a bullish or bearish outcome, we don't know. The trend is still down, so it might still work out to be a bearish triangle. And they actually tend to work in 5 waves, but they're also labeled with letters instead of numbers. So let me just get my tool out here. You'll tend to see that triangles, sorry, let me just get rid of that, works in 5 waves. A's, B's, C's, D's, and E's before a correction ends and the previous trend resumes to the downside. Guys, I'm not going to get too much into triangles again at the moment. There's another variation, as I'll show you in the next chart I'm going to show you, that are called descending triangles. Instead of a symmetrical sideways movement, they have flat bottoms or flat tops. Okay, so either ascending or descending triangles, this is what's called a symmetrical triangle. I've also done a previous video on triangles, and now I used Elliott wave retracements to actually decide whether we are dealing with a triangle and using it in a specific manner to try to figure out where the final wave might end before the trend resumes again. Okay, so that is definitely, in my opinion, a triangle. It's still one that might be underway or one that just finished. So we wouldn't know how that turns out, but it's pretty easy to see triangles on a chart because they have sideways movement that contracts to either a point before a trend resumes again, or like I said in this, it'll show you now, we even have a variation of triangles, what they call ascending or descending triangles. This is a fantastic example, just scouring over previous chart ideas. And this is on a US dollar ZAR, which is South African Rand, the currency in the country that I live in. We have an uptrend here. And again, guys, just assuming that the trend was going up. And, sorry, let's change that color. And you had this sort of high over here. Price then start moving lower, and it starts moving sideways in a discernible pattern. And this is a bit of more of a complex one because we have a flat line down at the bottom here. It will be reasonable to suggest that this might have a bearish outcome when this triangle finishes. Otherwise, let me just label that for you. So we have one wave down, A, B, C, D, E. Now this is what's called a complex correction, because in the bigger schemes of things, this was actually just an A, and your B wave would have ended where this triangle ended, and your C wave down here. Guys, it might sound very complex. Obviously, if you had a bias that's still to the upside and you were trying to buy into the US dollar ZAR, then this Elliott wave pattern, because it's not a symmetrical triangle like the previous one I showed you, you see that it's got a flat bottom. And as soon as you see a flat bottom on a triangle, they're called descending triangles, and I would say more than 90% of the time will have a bearish outcome. But this is what's incredible about Elliott wave work is, and especially as you'll see now when I use my pitchfork to see if this was a C wave, your actual B wave here also pulled out or created a more complex pattern, which is something you'll see quite regularly. So if it wasn't for Elliott wave analysis, and then in my opinion, you would not have been or had a good idea that you might be seeing a last wave down too. Also in previous moves or previous videos that I've done previously, guys, sorry, you also note that these triangle patterns are what they call terminal in nature, which basically means they tend to pop up as the last correction before an important high or low would form. So in this case, although it was part of a correction lower, when the C wave ended, this was actually just an ABC, like I said. Your B wave actually tracing out more complex. And it was the last correction before a C wave. Just knowing these sort of things can really give you an edge. And this is what's really incredible about knowing a little bit about market structure, especially using Elliott wave, that if you simply use that high to this low and moved it up to that one there, yes, price very, very closely touched your lower median line. So even if you, lower red warning line. So even if you assume that it could end here, you would have been right. Let me just put my magnet mode on. If you use that high again there, but instead connect it to the B wave, which was actually ended here. So it's not, the B wave didn't end here. This is not an A, B, C. It was an A, B, C. And using those pivots can really, in most cases, guide you to know which exact pivots you should be using when drawing market geometry. And this is a beautiful example here. Even if you use two different ones, you don't know which pivots to use. If you watched out for an area of confluence where two of these lines could sort of like in a zone cross each other, then that would have been a fantastic buy setup there. Obviously, there's more to it. You have to be looking, depending on what your strategy is. But anyway, just a very good takeaway as to how this is a descending triangle, but in this case, it was a descending triangle as part of a correction. I know, guys, this might all sound very complex, but believe me, if you start looking at charts a lot and you start counting 3s and 5s, and especially apply these over corrections, then and really make a good study about how actual corrections tend to appear using Elliott wave, then and then in combination with market geometry, then you really got a really good, I would say, a leg above all the other traders out there. And then finally, the one that I just jumped over was what we call a expanded flat. So how this tends to happen out is that you'll normally have price going into an high, like in this example here, but then price made 3 waves moves to the downside. But then it's reasonable to expect, as Elliott wave will tell you, that if you were going to continue a trend, that you at least have 1, 2, 3, 4, 5, like this move over here. But here we just had 3, and then price came down. When that happens, then immediately knowing how Elliott wave works should have told you that that 3-wave move higher, if you think you're dealing with a correction, that gave you away or gave the pattern away that we're probably dealing with an expanded flat. Now, expanded flats can be quite volatile in nature. They tend to end around about previous high and then immediately reverse against you. This is a correction that kind of catches a lot of traders unaware, especially if there were a lot of buy stop orders or breakout traders above these levels and immediately see price reverse against you. But what gave this away, again, the DNA or say the behavior of this pattern would suggest that we only had 3 moves into this high, and then you should immediately start thinking that you might be dealing with expanded flat. And how I deal with them is simply I'll use the previous high to that A there to this B here. And this is very important. If you want to be trying to find the end of corrections, you need to slope a pitchfork in the direction of what the market's moving in. Obviously now it's showing up. So we want to then again, in this case, use a different setting. If you use a modified shift, it wouldn't work. It's still sloping up. And this is one of the only times that I will use the standard pitchfork setting. And you'll see here that on this expanded flat, where your C wave quite often carries way below your A wave. Some cases it will actually just sort of stop where your A wave was, but in most cases it will actually just drop straight down and immediately reverse, quite often to a V shape to the upside again. So here we got a good example of just knowing which pivots to use, because there was no pivots to use over in this section to find this low. Would have given you the low of this. Yes, price shot underneath that. Just a quick another tip that I want to show you is that if you use a Fibonacci retracement levels and you measure that from the A to the B, let's just get rid of this. Sorry guys, my drawing's all over the show again today. Apologize for that. If you go from your A and your B wave on your retracement side and you also activate your extensions to the downside, you could have just used basically an extension from that high to this low back to there and extend it lower. But I quite like to do it like this. Then expanded flats tend to end at your 1.382 and in some extreme cases 1.618 or the 1.786%. But that's also quite important that we at least want to see a confluence of multiple lines, like I'm continuously telling you guys. At an area, we got a 1.382% there. We used the right pivots. Everything was given away by just a 3-wave move here, because trends don't start with 3 waves. They start with 5 waves. And basically giving us a zone of confluence. Lower median line of the standard pitchfork. That's one of the only settings I quite like to use on expanded flats. And the confluence of, like I said, the 1.382 and a low median line. Again, gave you that low and price went upwards. Obviously, guys, this is a lot in hindsight, but it really does give you an edge if you start understanding how patterns work. You understand how they tend to behave, and then using different tools like your Fibonacci extension, retracements, and especially market geometry lines, then you, in most cases, you'll definitely get a good idea where such a correction might end. Like I say, a lot of these corrections give away the intentions, like in this example, yeah, only 3 waves up made me, or would have made me think that we're only dealing with an expanded flat, and this is how you deal with an expanded flat. Okay guys, this was probably a little bit more of a longer video than usual. I hope I addressed some of the questions on Elliott wave. Just as a recap, I'm not a big fan of trying to label trends. I do, however, like to understand how corrections tend to happen and then use Elliott wave theory to act as a guide in combination with my market geometry lines to figure out where such a correction might end. So if you're interested in these sort of things, I really suggest that try to just focus on corrections. I know a lot of Elliotticians will probably want to kill me for saying so, but using this in combination with other tools is really a powerful means of trading. Okay guys, and that concludes today's video. If you liked what you've seen and you've not subscribed to this channel before, then please hit the subscribe button. I would really appreciate if you hit the like button, and as always, please leave some comments in the section below and we'll be happy to answer them. Okay guys, until next time, have a great week. I hope you enjoy your weekends, and I'll be back next week with another exciting video. Until then, take care. Bye bye.